Hey guys, it is showtime. Welcome to the broadcast. We're going to talk about some things today, but today I thought I would just get some coffee like this, and we're just going to have a fireside chat today. There is going to be a little bit of education because that's the way I roll, and it's going to be kind of fun for me anyway, probably not for you guys. But I think it's important stuff because these terms that we're going to talk about today are used all the time in our earnings season. And it's really important to understand the nuances around that. So I had another thing going on there. Okay. So with that, I've got a few folks in the room here, but there's not that many. So I think what I'm going to do is go ahead and get started, and we'll go through our little education thing. Then I'll come back and actually kind of see who all's here and open the party up, so to speak. So let me just share this. I'm going to share this info right here. Earnings season, two things to know. There's probably more than that, but at least these two: non-GAAP earnings and consensus estimates. So you'll hear companies will say our non-GAAP earnings they may use other terms. They may use, our normalized earnings or our adjusted earnings or something along those lines. They will have a different name for their earnings. And so we want to talk about what that is and why do they do that and how should we think about that. And then the second thing is consensus estimates. Who provides those estimates? Where do they come from? Why do we even care what the consensus estimate is? I think this will be good information to have for all of my friends who are going into this earnings season on the edge of their chair waiting for some earnings announcements. So let's go ahead and get started. I have here... Oh, yeah, here we go. Generally accepted accounting principles. Now, I can see your eyes glazing over already. Just get those toothpicks and hold those eyes open, if you would, because it's going to be educational, but you got to stick with it. So first of all, GAAP, generally accepted accounting principles, is the set of accounting rules set forth by the FASB, which is the Financial Accounting Standards Board, that U.S. companies are expected to follow when putting together their financial statements. Now, the goal of GAAP is to ensure that a company's financial statements are complete, consistent, and then for us investors, what we care about is that they are comparable. We want our companies to account for processes, account for transactions the same way, regardless of what industry they're in. And so we want them to be consistent so that we can compare our investments one against another. Now, for my international friends, there is a GAAP that is used in the international world. It's called IFRS. Some people have tried to call it IFRS, but it just doesn't ring well to me. I just like to say IFRS. It's International Financial Reporting Standards. There are a lot of consistencies between them, but there are also a lot of differences. And so this course, if you want to call it that, this discussion is not about the differences, but I just wanted you to know that that's out there for companies who are based in other countries. So if a company, let's say Johnson & Johnson, all of their accounting, regardless of where it is in the world, would need to follow GAAP because they are a U.S.-based company. So whatever that's worth. So now let's move on to the more important one, which is non-GAAP earnings, because you'll see most companies say our non-GAAP earnings were. And they either they beat their estimates, met their estimates, or they missed their estimates. So what is a non-GAAP earnings? It is a pro forma figure, but it excludes one-time transactions such as like an organizational restructuring. So if they've reorganized the company and their expenses related to that through severing people or whatever that may be, then they would want to account for those in a separate bucket, so to speak, and remove those from the GAAP earnings, so that as we're looking at this company and we're looking backwards, we can say what their earnings were in a previous year, And as we look at what they're expecting in future years, we can try to get at least apples to apples across that time frame. So that's why companies do this. One thing to note, though, reconciliations between GAAP and non-GAAP are required to be disclosed. Now, most of the time, they will be in their earnings slides that they go over with the analysts, but they will be near the very end because they don't like to put them in there. But it is what it is, right? They are required to disclose it. They will show you what the difference is between GAAP and non-GAAP. So I thought it would be fun to look at some examples of these, just so you can see what they look like if you haven't gone down this road before. So this is WEC Energy Group. As you know, I did a video on that, so it was fresh on my mind. And one of the things I found interesting about WEC Energy Group is that you can see here they have the EPS GAAP basis, and then anything that's causing a difference, and then what they're reporting for their EPS non-GAAP basis. Here's another interesting piece, though. WEC had adjusting items or reconciling items in 2014, 15, 16, and 17. And then they did not have any more adjusting items until 2023. So that is typically unusual, especially for a utility. So, a lot of utilities will have, pension and stuff like that in there as reconciling items. WEC does not do that. You'll see that they have for 2023, they are projecting a disallowance in Illinois. This is a rate making issue, and it's going to cost them about 41 cents per share. So they want to kind of exclude that from their earnings this year for investor purposes, because it's not going to happen, in previous years. It's not happening in the future years. So if we want to get apples to apples, we have to, get that out of our minds. So that's an interesting here. I thought was an interesting one as well. We have IBM, and the first thing you'll notice is every company has a different looking reconciliation. So it's almost like you have to, familiarize yourself with how they are going to show you the difference between GAAP and non-GAAP. In IBM's case, and this is an old one, this is back in second quarter of 22. I'm not sure why I picked that one. It was just the one I had up at the time. But you'll see that they give you GAAP to non-GAAP on a lot of different items: gross profits, SG&A, all the way down to net income, and then earnings per share. So the one that we care about the most is this earnings per share. I can't highlight it, but earnings per share, they had a GAAP earnings of $1.61. Then they're going to show in these columns here what they are factoring out. One is acquisition related adjustments. Everybody knows that IBM has a merger and acquisition strategy in terms of growth and acquiring this technology that they need. So they're saying, hey, when we acquire a company, it costs us money to do that. So we are going to carve that out. It is not part of the going forward numbers. So you shouldn't compare that in the future. Retirement related adjustments. I'm sure this is pension related. I didn't look it up, but that's what they're telling us. They have a column here for tax reform impacts. It's basically zero. So that was not important. And then, as you know, they spun off Kyndryl at some point. I don't remember exactly when. And they had some expenses related to that. So in this particular quarter, they said, here's the Kyndryl spinoff numbers. So our GAAP number was $1.61, but there's all this stuff that we want you to kind of not pay attention to. We want you to look at this $2.31 number, because we believe as a management team that is the most comparable to what it was last year and what we believe you should compare us to moving forward. So one more example, and I will move on to a different subject, but another example is Microsoft. Now, the best I could tell, Microsoft only normalizes one item, and that is constant or currency exchange rates. So they state their financials on a constant currency basis. So when they say, constant currency reconciliation, they're saying, hey, we reported, this is 22 and 23. we reported earnings per share of $2.35 from a GAAP perspective. And then in 2023, it was $2.99. But we want you guys to know that the constant currency impact is 2 cents per share. So that's just another way of kind of telling you what's behind the scenes in some of these numbers. So here's some takeaways. Financial transactions can cause earnings to not be comparable from period to period. You know, we've seen some of those with, acquisitions, divestitures, the restructuring of the business. There's some things that a business can do, a transaction that they can enter into that would make it not comparable, and it would confuse us as investors when we're looking at these sawtooth earnings. Secondly, management carves out these items so that we can, as investors, more easily determine the performance of a business from a trend perspective. The third thing, and this is going to be new here, and it's just, I think this is probably worth your time to be on this live stream today. Balance sheet and cash flow statements will typically represent GAAP with no reconciliation. Why is that important? It's important because the next bullet, the earnings payout ratio will typically use non-GAAP. So if you're looking at IBM's earnings payout ratio, it's going to be based on their non-GAAP number, that $2.31 number versus the GAAP number of 161. So that's going to, tell you on a trend basis what the earnings payout ratio is. However, when you look at the cash flow payout ratio, it's going to be on GAAP. And so sometimes you'll get a wide disparity between payout ratio, earnings payout ratio, and cash flow payout ratio. Sometimes the difference are the GAAP to non-GAAP reconciling items. So that to me is worthwhile to know. And, the last thing is every company is different. So you got to review the reconciliation, and sometimes they will word it in a way that just doesn't make sense. We don't know what it is. And so we typically will ask each other as we collaborate here in our group, what does that mean? So that's GAAP versus non-GAAP. Hopefully that was helpful. And I'm going to move on to the next one, which is consensus estimates. Now, consensus estimates are made by analysts, and they project what they believe the earnings are going to be for the company based on their own modeling. But what they will do, they will have a model that they, and there's some smart quant people who are building these models, and they will take information from public statements made by management, and they will put assumptions in to this model. And they will say, oh, based on all of that, this is what we think the earnings are going to be. Then there are multiple analysts. So this is a little misleading because it says consensus. Consensus usually means that you get people together and you talk about the pros and cons, and you come up with what you all believe as a group the consensus is. It doesn't happen that way. They basically take what the analysts say and they average them out. So a consensus estimate is really the average of what the analysts are believing. And they're based on what is publicly available for the analysts. And it's important, the rest of this bullet point here, NPI, I used the acronym and I should have spelled that out. NPI is non-public information. There should be no non-public information in the analyst information. And that's obvious for many reasons. And this is a bit of an extra. I will throw this in for free. The analysts should not know what non-public information is for a company. However, somebody like Standard & Poor's, who is giving a credit rating for the company, is allowed to know non-public information. They have to sign non-disclosure agreements. They have to agree not to buy the stock and things like that. But they can know what that is because from a credit rating perspective, it's important for them to understand the business and what's going on and what may be coming down the road. So I don't know if that matters to you, but it is important that analysts don't know non-public information, but the credit rating agencies do know non-public information. Next, analyst projections are average. We talked about that, and it is not truly a consensus. We talked about that. So let's move into the earnings for this week. And actually, this is one of my favorite, I guess, charts to look at when I look at earnings coming out this week. There is a little bit of a drawback here, and that's because, not all of my companies are on there. I guess they have to meet a certain criteria. So, for instance, this week on Tuesday before the open, so in the morning, I'm going to be looking at RTX. That's Raytheon, the old Raytheon, and Johnson & Johnson is coming in, and I got these a little bit out of order, but Texas Instruments is coming in after the close tomorrow, and then Lockheed Martin is before. So when I get up in the morning, there's going to be 3 of my companies in my portfolio that are going to issue earnings, and I'm thinking about doing a couple of videos this week. One on the earnings, at least from my portfolio for Tuesday. And then on Wednesday, we have IBM. So I might do a little short one on IBM just to kind of give my thoughts around what the earnings call meant for me as an investor for these particular companies. Let me know if you think that would be helpful. It would be a lot of work for me to do that. But if you guys would find that helpful, I may just actually do that. All right, so earnings are reported also in tip ranks, and you can see here that while we talked about Johnson & Johnson, Lockheed Martin, Texas Instruments, Raytheon, and IBM, there was one not on this sheet, which is General Dynamics. So General Dynamics did not make the cut for some reason. I'm not really sure why. I do want to take you over though and show you something that I think is kind of cool. But I have to switch you out. All right. There we go. There you are. Okay. Got you. I got you guys back now. So I'm going to stop sharing that. And then I'm going to present a different screen, which should be this one. Okay, so this is tip ranks. And one of the things that this shows me is, this is the portfolio here. I've actually sorted this on the upcoming earnings date. You can see that over here on the far right. And then we see here that Johnson & Johnson, Lockheed Martin, Texas Instruments, Raytheon, General Dynamics, IBM are all reporting out on the 23rd. I'm sorry, General Dynamics is the 24th and IBM's the 24th. So, but one of the cool things is when I go into, let's just take Johnson & Johnson, it'll tell me in a glance what the earnings estimate is, which would be $2.28. And if I click on that, it'll also tell me the history of what the earnings were versus what the consensus estimates were. And so it just gives me some good information. I thought I would share that with you guys today because I just find that to be kind of cool. So let me go back to this other thing. Share. Okay, we're back. So there's that. So here's some takeaways. Consensus estimates, consensus earnings are from analysts, not the company. Consensus estimates may be lower than last year's comps. So, it's not, basically they're not taking last year's numbers and giving you that as an estimate. They have these complicated models that they believe that they can calculate what the company should do. So it's not just, last year's comps that they're giving you. It's a real calculation that they're doing. The third thing is the stock's price typically assumes the consensus estimate. So if a company has gone down in earnings, that's typically going to be reflected in the stock price. So if even though they may have done more poorly than last year, but they come in ahead of consensus estimate, you might see a tick up in the stock because even though they did worse than last year, they did better than what was estimated. So it's important to know that. Analyst projections are averaged for a consensus estimate. We already talked about that. And it is not truly a consensus. It's really more of an average. So But that's what I have for you guys today. So now what we're going to do is get rid of this, and then we're going to just chat for a little while. And I've got my coffee. I don't know what you guys have. But I thought what we would do is go in and see who all's here. So we've got currently 19 on the program. So we got Slammer is in the house. He said you got here early. Yes, you did. And I even responded and said, yeah, I got here early myself. We've got NK in the building. And we've got Suzuki Man, who just basically waved at us, I think. So that's awesome. Jim is here. Jim Betts, good to have you here, my friend. We've got Eli. Eli has made it to the program. So Chris, he says he's been swamped. He's glad he can catch this. And so he's asking, what's up, everybody, and me as well. We got Brad Durfee in the house. Brad, it's great to see you here, my friend. Kenji is awake and I'm alive. Yes, at least at this moment. That is absolutely true. So let's see. Jim's got something here. NPI equals insider information. No NPI keeps the guys with windbreakers stamped FBI from showing up at the fund manager's door. That is a great way to say that. It is you definitely, as a management team, don't want to disclose anything that is not known publicly, because if you do, you only have a certain amount of time to get that out into the public. I don't remember how many days it is, but it's a pretty quick turnaround. So if you mess up as a CEO and you're meeting with some analysts in a meeting, on site or off site or wherever it is, and you give them some non-public information that you haven't told the rest of the world, you better get that out, because that's going to be a problem. So that's exactly right. You definitely don't want the FBI guys at your door. All right, I'm going to move this up here so that I can see better. Oh, that's much better. Okay. So Chris here says Visa and LHX on Thursday are what I'm looking at. I should have loaded the boat on LHX when it dropped into the low 160s. So let me see what, I don't want to go there. Let me see what LHX is. I'm going to go ahead and get rid of this. And I'm going to present this other screen over here. So I'm going to switch over to Simply Safe, because I do like their layout. LHX. Oh, yeah, L3 Harris. I don't know why that wasn't ringing true. But yeah, I hear you, man. All of that, that whole sector is... Wish we would have gotten in on a lot earlier. So, yep, that's going to be good, my friend. Let's see, what else do we have here? Early bird gets the worm. That is true. So, who got the worm today? It is Slammer 6789. So, I'm not sure what that gets you, but hey, you got the worm, my friend. My drive home from work, I get to listen. Are you retired or something? How are you on here so early? Yeah, this is a great question. So I got some feedback from my international friends, and they said, hey, you know what? It would be great if we could set this up where we can join when it's not in the middle of the night, our time. So, I've done this for the past, I think this is my third time coming in at 3:30 Central Time. So that would be 4:30 Eastern Time. It's about 30 minutes after the market closes, but I think what I'm going to do is I'm going to send out another poll and see if you guys, now that we've done about 3 of these, see what time really works best overall. I might actually do one earlier and one later to kind of hit both, but I don't want to confuse people either. So anyway, we're still working out the bugs on that, but I thought it would be better, instead of saying, no, I'm going to keep it the same time, to actually just try it and see how it worked out for people. So that's what we did. And that's where we're heading. We're just we're not making this up as we go, but we are testing the water. We want to see what works well for everybody. Oh, great lecture about the reconciliation. Thanks. You're welcome, Gnome. I appreciate you being here, man. Miguel is in the house. Welcome, Miguel. It's good to have you here, my friend. Oh yeah, I was wondering when this would come up. I'm surprised it took until 25 minutes into the broadcast. Any thoughts on ADM news today? I'm not invested. So yeah, I have a bunch of thoughts on that. Um, you know, going into today, I did not own any ADM, but I took a. Let me show you some things. I'm going to go ahead and take this off the screen, but let me show you some things about ADM that I thought was interesting. So we'll just pull them up on here. Archer Daniels Midland, first of all, has a 94, very safe dividend rating. The dividend yield this morning was not 3.45%. You can see that the stock ended up down 23.4%. Huge drop off. And for those of you who don't know what's going on with Archer Daniels Midland, they evidently have some accounting shenanigans going on. They have, over the weekend, they fired I don't think they called it fired, but anyway, they got rid of their CFO. And typically, if you got an accounting mistake or something along those lines, you don't fire the CEO or the CFO. You fix it and you come up with corrective actions and you move on. There must be something going on from a fraudulent perspective for them to get rid of this guy. So something's going on the financial side. They say it's around the nutritional segment. I did some research today. The nutritional segment of ADM is about 10% of the earnings, at least their operating earnings of the company. So when I look at that and I look back over time and I said, how many earnings have they had? So since 2014, if I add all the earnings from that segment from 2014, we're talking $6 a share. So even if they got rid of all the earnings from this segment, for 10 years, it wouldn't be more than a $6 per share impact on the company. I don't think that would be the case. I think they're probably talking about maybe how it was reported. Maybe they reported some extra revenue or something like that. The consensus estimate, stop me if I'm going too far into this, but the consensus estimate for ADM was about $7.27. They're now coming back and they're saying two things. One is we were going to report earnings, but now we're going to delay that because there's something going on in the financial statements. That's important to know. We don't know what that is, and we don't know the extent of it. But what we do know is that the company came out and said, we are now getting rid of any future guidance that we gave you, but you can expect somewhere north of $6.90. So we went from 727 to 690, let's say. That's 37 cents per share. The stock price dropped 23% today. So, I'm looking at that and I'm looking at the potential, there's some other thoughts that I have. One is that anytime something like this happens, at least from my experience, the market will automatically think the worst. And we can't blame them, right? That's what they can only do what they know, and that is, hey, the potential of this is really bad, right? But most of the time, it is not as bad as it looks, or it's not as bad as we originally thought. So we've got, people afraid, investors, especially big investors, afraid. They are dumping these shares. We've got people who are trying to ride that train by selling short and that kind of thing. So that then need all these robo trades. And so that typically will drive the shares even lower. So guess what? Normally I wouldn't do this so quickly, but I actually picked up some ADM shares today just to ride this back up a bit. I'm not planning to keep it long term, but I do have a few shares. Not much. I didn't go crazy here. I'm not betting the boat on this. So even if it goes bankrupt and goes away, I would be mad at myself, but I wouldn't lose any sleep over it. All right. But let's look at some of the financial numbers. First of all, their dividend growth has been really good. And, one of the things I like about investing in dividend paying companies is that you can't fake cash. If you're paying dividends, you're making some money somewhere. Might be borrowing it, but you're making it. Let's look at the earnings payout ratio. A very healthy low 20%, and it's going to go up to about 28% because earnings are falling off. With the economy doing what it is, their earnings are falling off. They invested in some stuff, I guess, in the last 12 months, but they're expecting that the cash flow payout ratio to be around 37%. Here's some other cool stuff. You can see where the earnings are dropping, but they have earnings. Look at this, $6.48. So even if they got rid of the last 10 years of nutrition, it just means that they would only make 48 cents this year as opposed to 6.48. I don't expect that to happen because they're giving guidance that says 6.90. So not really sure what is going on there. You can see they've been buying back shares. You can see that their sales have gone up. Most recently, they're down. Their return on invested capital is not terrible. It's more than what I believe their weighted average cost of capital would be, which is okay. Look at this net debt to capital. It is 25%. So that is actually a pretty healthy debt load from my perspective. The only thing is that their interest coverage ratio is a little bit below the 8 that I like, but that's not that alarming to me. So the point is that as I look at all of these metrics, the company looks to be okay. And if they've got some accounting shenanigans going on, if they have a little bit of fraud going on, maybe they'll arrest the CFO or whatever. But the bones of the business look okay to me. These could be my famous last words, right? Who knows? I don't know the extent of everything, but I do believe that there is some upside potential here in the short run for ADM. I could be totally wrong, and so this is not a suggestion that anybody should do what I've done here. But I'm taking a shot, and we'll see what happens. So, great question, Chris. And those are my thoughts on ABM's news today. So I think maybe you got more than what you were really wanting, but hey, you know what? That's what I'm here for. That's why. That's why we have this live stream. It's like live and uncut, man. So Noam wants to know, which YouTubers do you like or follow and recommend, as well as podcasts? This is a good question. Let me kind of go through just off the top of my head the people that I really enjoy listening to. I like PPC Ian. He was actually one of the first YouTubers that I started listening to. I find him just to be a genuine guy. And so, doesn't mean that I agree with everything that he says, but it's just kind of fun to hear where his mind's at and what he's thinking about. And another one that I like a lot is Ryan Williams. And I think you guys know that because he's one of my favorites. Also, Russ from Dapper Dividends is one of my favorites as well. I will typically, unless I'm tied up, I will typically catch all of their live streams. PBC Ian doesn't do a live stream, but I will catch Ryan and Russ's live stream, at least part of it. One other one that I listen to is Joseph Carlson, and there's a few others that are escaping me right now, but those are some of the big ones. So that's a great question. I've never been asked that before, so I appreciate that question, though. Okay, yeah, we have Chris is saying here that L3Harris is a defense contractor. It's in a turnaround, very shareholder friendly, recently acquired Aerojet. Okay, well, that's good. So hopefully they will do well for you, my friend. Jim says here, Stellantis penned a deal with SIXT to provide them with up to 250,000 high-end rental vehicles. SIXT is a publicly traded company and was named the best car rental company in North America, I guess. Thoughts on SIXT? Well, I don't have any thoughts on it because I don't even recognize the ticker, man. What is that? SIXT. Sixth Street Specialty Lending. So let's take a look at that, Jim. See, I'm going to put this up on the screen here. I'm going to take your comment down so you can see it. So it looks like it's got a safety score around 52, so borderline safe. That's not the end of the world. It's got a pretty high yield, though, of 8.34%. And guys, it's time to take a drink of whatever you're sipping. Let's see. It went up 1.2% today. That's not too shabby. Let's see what some of the financials look like. The dividend growth is not that great, and that doesn't surprise me because we have 8%, 8.34% dividend yield. So we wouldn't expect there to be a lot of dividend growth. They do pay some special dividends though. That's pretty interesting. February, May, August, and November, they paid 9 cents, 4 cents, 6 cents, and 7 cents respectively. So that is actually pretty cool. I have some special dividend payers. Looks like they're pretty consistent with where their yield and payout ratio has been historically. Now let's look at some of the fun stuff. So remember, Archer Daniels Midland was around mid-20s earnings payout ratio. Wait a minute, this might be the wrong stock. Hold on, SIXT. That's what it says. This is probably the wrong stock, man. Is that? Help me out, Jim. Is that the right? I'm going to look down here and see if you've tried to catch me on this. Yeah, I don't know, man. I don't see an SIXT. I see a TSLX. So maybe you can help me out with a. Let me go in here and see what I find. SIXT. No, all I get is like 6. Here's something. Yeah, I don't know, man. I am not finding a ticker that says SIXT. So are you sure it's public? I don't know. Give me some help there, my friend. We'll look at it. I just need to be able to find it. And anyway, so if you're looking for 6th Street specialty lending, it is it's not one that would be attractive to me. I'll just put it that way. In the little that I've seen of it. So TSLX is not on my list. All right, I'm gonna get rid of that. ADM tried to sell a put. Options were even listed for it today. Too volatile, I guess. I'm going to keep looking at it. Income play for me. Yeah, absolutely. Usually when there's a huge drop like this, the options will be pretty thin because, options traders don't know where it's going. And neither do the stock people. And that's why I went ahead and just bought some shares because, if I'm going to gather some of this, it's going to have to be from an equity side, not from the option side. I think that's my take on it. Aldo's in the building. What's going on, my friend? Greetings from Wasaga Beach, Ontario, Canada. Welcome. You're not over the pond, but you are over the Great Lakes. It is good you are here. So, yeah, you're absolutely right, Chris. You are welcome for my thoughts. And that's basically what they are my thoughts. So if any of that helps you, I'm more than happy. But it is none of this is considered advice. I'm not trying to get you to buy anything or sell anything. I'm just telling you what I see and how I see it. So, and that's what we're about, right? This is just about being transparent and honest about what we're seeing. So Miguel Fernandez says, I did the same, added some shares today of ADM. So, all right, welcome, my friend. We are on this bus together. So at least I got somebody to sit with on the bus. How does that sound? And if that bus goes over the cliff, hey, we'll go down together, my friend. So we've got any thoughts on Dollar General? I don't typically think about investing in Dollar General, but let's take a look. And let's see, DG, Dollar General. Dollar General has a borderline safe rating. They've got a 1.75% yield, which is pretty low. It means that they're expecting a lot of growth. But man, look at that dividend growth. It is over the last 5 years, it's 16%. The latest one was 7.3%. Let's take a look at some of their financials. The earnings payout ratio is climbing, but that's not unusual. It's we're going into a rougher time. Sorry about that. I need a drink of coffee. Free cash flow payout ratio doesn't look that great. It is coming back, but that's not looking so good. Earnings per share is dropping. Free cash flow per share has dropped significantly and is now going back up. Looks like they're doing a lot of share buybacks. They've gone from 324 million shares in 2014 to 221 million. Their sales are rising though, so they're just less profitable sales, I guess. Return on invested capital seems to be moving downward. So that's not so good. Net debt to capital. Wow, they've got a 73% debt to capital. That might be because of all of these share buybacks. I think I've mentioned before that anytime a company buys back shares, it reduces their equity balance on their balance sheet, which would impact the net debt to capital because they would have less equity and more capital, more debt. Interest coverage ratio is it's not terrible. It's 8.64. So that's not so bad. There's just nothing there that really excites me, to be honest, Miguel, about Dollar General. So I'm going to stay away from that. And I could be totally wrong, right? I mean, it could double in price tomorrow, but it's not something that really gets me excited. Okay, we've got Suzuki Man. He also took a gamble. All right, put your money in the machine. And he bought 10 shares of Procter & Gamble before earnings. So I think the gamble part is the before earnings. Procter & Gamble's obviously a great company. So it's not a gamble on whether they're going to be successful, but they got some news coming out. And sometimes if you buy before earnings and you get some bad news, it could go the wrong way. Okay, Jim, ticker might be SIXGF, SIXTSE. All right, let me try that one. Let's see, SIXGF. Yeah, I don't see that one either. Oh, there it is. Yeah. Wow. Yeah, this makes more sense. Passenger ground transportation. It's an industrial. They didn't move at all today. Basically, a 0.0% move. They do have some dividends, but for whatever reason, they are not rated by Simply Safe Dividends. Looks like they got a long history. Oh, it looks like because it is foreign, it's actually in euros. That may be why. Looks like it moves around quite a bit. They have earnings that went up to 9 in 2018. It was at $9, then dropped to negative 0.73. That was back during COVID, so that makes sense. And they're down around 7.3 now. Just trying to see if there's anything that causes me to be interested in this company. The return on invested capital is not terrible. Their net debt to capital is pretty high, but if they're an early company, that might be reasonable. Their interest coverage doesn't look that great either. At least the last 12 months, anyway. So I don't know, my friend. That one. I would have to dig a lot into that one, and I don't see anything there that causes me to want to be honest with you. Was that too blunt? It's maybe I should be more less blunt about that, but there's just really nothing there that grabs me and says, you need to look at me to invest money in. But if there is, man, let me know, because I would love to obviously find great investments. I mean, that's why we're all here, right? So I may have missed that, but not too excited about that one for some reason. Okay, yeah, I think we got it, Gnome. So let's see. Thoughts on Uber? Sold a put today, 67.50 strike with 721.24. So that's what, about 6 months. $750, made $200 on a put a few weeks ago. Currently trading at 65, 20% growth expected. No dividend, but the options premium is good. Huh. Yeah, it's just hard to know with Uber. Let me see if Morningstar actually. I'll get you guys over here. Hold on. Let me see if Morningstar. You get to see my screens while I pull these up. Let's see. Uber. I think that's it. Looks like they cover it. So let's see what they think the fair value is. They're saying the fair value is 68. So, you got a 67.50 strike price. I mean, it may go there. That's certainly a very reasonable thing. And I think it's currently trading at 68. No, that's currently trading at 62 or 65 according to your thing. So yeah, it might that might do okay for you, man. I don't know. I don't know enough about Uber. I have taken Ubers before, but since they don't pay a dividend, I really haven't played that much with them. Sorry, I don't have any better advice for you on Uber, but I don't want to just make stuff up either. Is ETN too pricey to buy at 52 high? This is Mike. Hey, Mike in Milltown, New Jersey. Welcome back, my friend. So I don't know. Let's take a look. Let's see. I'm not sure if that's going to be in here or not. That's Eaton. Yeah, they should be covered. The fair value, according to Morningstar, is 208. They're trading at around 240. Let's take a look at some other stuff. I'm very familiar with Eaton. I used to be in a group that had the chief audit officer from Eaton in it. So they have dividend yield 1.41, safety score 85. Oh, you're not seeing this. There. Let's get you, let's take that off. And then let's come back over here. Simply safe dividend score of 85, dividend yield 1.41. They went down a bit today, 0.2%. Let's look at they've got a 6% dividend growth rate, 10% over the last 20 years. So that's good. You can see it's up and to the right. So we love to see that kind of stuff. What I usually will do though is when I see this and see that climbing, what I'm going to look for is what is the payout ratio doing? And therefore, are the earnings keeping up with the way they're growing the dividends? So let's go take a look at that real quick. And not only is it keeping up, but it is actually improving. So their earnings are growing faster than what they're raising their dividend. That's a great sign. But it appears that according to Morningstar, appears overvalued. But beauty is in the eye of the beholder, my friend. They've got about a 13% return on invested capital, so that's not lighting the world on fire. Their debt looks fine, and their interest coverage looks fine. So, yeah, it's a great company. I do like Eaton, but I don't like it at these prices. Let's take a trip over into tip ranks, and let's look at ETN. Okay, we have 243 is where it's trading now. They're saying that it could be as high as 275, but on average 247. So it's showing about a 1.56. I don't know if you guys can see that or not. Maybe I'll blow it up a little bit. See that 1.56% upside according to analysts, but what do they know, right? But it is a data point. It could go down as low as 220. So yeah, I don't know. It's not. I would say it for me. If I were investing right now in Eaton, I would probably wait, just because it does look a little bit on the pricey side. So, Mike, hopefully that helps. That's from my perspective only, and but that's the way I look at it. Okay, yeah, we got it. I think we took care of that, Jim. If not, let me know. So we got Chris says, I'm always interested in someone else's opinion and thoughts. I may be missing something you see. DD is on me. Absolutely, my friend. That's the way it works, right? I mean, we're in this group together. We grow together. We collaborate together. But at the end of the day, it's our own individual portfolios, and we've got to make those decisions. And whatever that decision is, we own it, and we will stand behind it, even if it goes bad, because sometimes they do. Yeah, ex-dividend dad wants to look up MPW, so let's do that. I did not buy MPW, by the way. So let's look up MPW. Let's go to tip ranks here. Look up MPW. So today we'll go to the chart first. So today it went up. It went up 5.54% today. So that's not too shabby. So that's good for all of you MPW stockholders. But boy, is that going to be a mess, huh? I'm actually expecting MPW to have a pretty decent earnings call. And let's look up, their earnings are on February the 1st. So today is the 22nd. So what is that, about a week and a half? Let's come back to MPW and see what we think, because it's looking like they're going to have a pretty, well, I don't know if it's looking like, I'm thinking, my gut tells me that they've gotten their bad news out, and now they're going to have hopefully something that will excite shareholders again. That's kind of the way that I would do it if I were running the company. So I'm thinking that there's probably going to be some excitement. Whether it moves the stock or not, I don't know. But I'm hoping, if they are doing what they should be doing as a management team, that they have gotten the bad news out. And so now it's about, letting the investors know what some of the good things are that they haven't shared yet. So it's okay if you say no. I appreciate that, my friend. But, who could pass up an opportunity to look at MPW? I mean, it is so exciting. Okay, we have, I can't tell who this is. That looks like Hebrew. So, but I can't read it. So you'll have to maybe tell me what I should call you. But I appreciate you here, my friend. And UNH, United Health Group. UNH, let's just go ahead and look that up just for my peace of mind. Because, when you get retired, sometimes you don't remember things as well as you used to. So dividend safety score of 99, excellent, dividend score, 1.47%. The dividend yield's a little bit on the low side, but, if you're younger, that's not a big deal. Look at this growth. This dividend growth is just going to the moon. It is a 16% 5-year, and it's pretty consistent. They did 14% about in June of 23. Look at that line, though, straight up, man. Let's look at their earnings payout ratio. Remember earlier we said that when this line goes up, we want to see the earnings payout ratio flat, and that is what's going on. And what that means is they are raising their earnings to meet the dividend that they're paying out. So I think that looks really good. Their earnings are growing. Their share count is not moving much, and that's okay. Their total sales are growing. Their return on invested capital is 20%. So if you're a long-term investor, what that means is that your company is making a return on the capital that it has to invest in the 20% range. And if their cost of capital, let's say they got a weighted average cost of capital of about, I don't know, 7%. Or let's just, for easy math, we'll say 10%. So if it costs them 10% for the capital and they're making 20% in return, that's not so bad. So I think that looks really good. Let's see, net debt to capital is 0.25, so that looks good. Interest coverage ratio is fine. I'm a fan of UNH. I don't own any, but it's actually looking pretty good. Let's take a look at some of the. Let's take a look at where the chart is on UNH. So today they went up almost 1.9%. Man, that's fantastic. In 5 days, though, I remember that there was a something came out with another insurer, whoever the it's escaping me right now, but the other major insurer in the U.S. and it caused there to be some sympathy pains here, and looks like that's kind of bouncing around a bit. Let's look at the last 3 months. It's also down 1.3%, pretty flat over a 6-month period. And then over the last year, they're up 7%. But, I think, and one other thing that I always look at is what does Morningstar think about it? And they believe that it is just a little bit over fair value. So, there, even though there's a number here that says $520, we all know that $520 is not an exact science. So it's somewhere in that neighborhood, and they're saying, hey, it's in the fair value range. So I guess from my perspective, it looks good. If that's something that you're wanting to invest in, I don't see any reason not to do that. I mean, you could always hope that the price comes down more, but it's in fair value range, and so the timing's up to you. But I kind of like what we're seeing there. Those are my thoughts. Ex-Dividend Dad says buy below 500. Let me get that off the screen. There we go. Buy below 500. So that would be great too, right? So yeah, absolutely, Jim. I'm happy to do that. We got Miguel. Thoughts on ResMed and Vail Resorts? I'm not that familiar with either of those, but let's just do a real quick thing here. Go ahead and pop this back on the screen. ResMed. Now, this is like sleep apnea stuff, I think. ResMed. Yeah, healthcare. It's got a dividend safety of 70. Let's just look at some of the financial numbers. Their dividend growth looks a little bit weak. The last one was pretty nice. But let's look at some of these things here. They got a great payout ratio. Earnings are growing. Sales are moving around a bit, but they have been growing significantly. Oh, what was that? Yeah, sales growth has been moving around. Their total sales are growing nice up and to the right. Return on invested capital is 20%. That doesn't look too bad. Net debt to capital around 23, and nice debt coverage ratio. So my rough thought on ResMed is it doesn't look so bad. So it might be worth looking into, actually. And Vail, I don't know. I know where Vail is, but yeah, this says unsafe. It's got a 3.68% dividend yield. I'm not sure why it's unsafe. They've been growing it pretty quickly. They dropped it during COVID, which makes sense. They're a resort. Let's look down here at earnings payout ratio. Well, and those payout ratios look really high, man, on both the earnings and the cash flow. So I would want to dig more into what's causing that, because that is not sustainable over time. So I think based on the stuff I've seen so far, my quick take would be ResMed looks enticing, and I would want to do more study on that. But Vail, I think I would pass on Vail Resorts. Those are just my thoughts on it. Yep, looking for thoughts on trades? Absolutely. All right, we got Greg is in the house checking in, but got to go get my turds, his kids from school. I'll watch the replay. Cheers. That is great, man. I think I will start using that with my kids when they call, calling them the turds. They would love that, actually. And he's listening from Southern California. So that is great, man. Watsco, Suzuki Man wants to know about Watsco. So let's take a look at that for my friend Suzuki Man. WSO, Watsco. It's got a borderline safe dividend, about 2.4%. Their dividend growth looks to be slow. Looks like the last one they gave was in October 22, and but their 5 years like 13%. So look at this on a 5-year. But again, there's nothing past 22 here, so they are getting pretty close to not having a streak. So hopefully they will do something and keep the streak. But they've got a 9-year streak at the moment, and you can see here that 1, 2, 3, 4, 5. The last 5 dividends, they have not raised it at all. Let's see here. Earnings payout ratio looks a little bit high, actually. It's above 60%. It's not, the end of the world, but it's something to keep an eye on. Let's see what their sales are growing, so that's good. Return on invested capital is nice. That is a nice thing that they have. Their net debt to capital is really low, so that's good. Huge interest coverage ratio, so that's fantastic. So it sounds like they got a lot of good things going on, but I tell you, in this economy, I don't know, man. It could be a little tough, but we'll see. Yeah, Humana was on the news. I saw that. I saw something on it earlier. Late last week, and I'm just having trouble pulling it back up. ELV Elevance had earnings this week. UNH could move with it, good or bad. Yep. That's right. And all these things are kind of tied together. So when you see an earnings for one of the healthcare insurers, you kind of see it kind of impact most of them. So Chris here says he DCAs into UNH, and he buys on the dips. He bought 15 shares when it dipped to 450 last year. That's a great approach. Rather than shooting the whole wad, maybe DCA is a better strategy for UNH. And then Miguel wants to know, is anybody buying Estee Lauder? I am not personally. I don't know about the group here, but well, guys, we have blown past the hour, and I'd tell you, I really appreciate you guys being a part of this live stream. I have a blast with you guys. It doesn't matter if I know what you're asking me about or not. At least we can find out together, right? So, so happy you're here. And I will leave with this. Tutomi has joined and says hello to everyone. So Tutomi, we are about to shut this thing down. We've been going for a little over an hour now. And so again, I'm going to put out something in the YouTube community that says that asks about the timing of this, because I know in the US it's pretty early and you guys are still working. So we'll try to find a good spot. But I wanted to try this and see how it worked for everybody before just asking, the thoughts. So, and Tutomi's got one other question. It's about ADM. So, Tutomi, if you would, I talked, I don't know, probably 10 minutes or so on ADM. So if you could catch that on the replay, that would be awesome, because I do have a lot of thoughts on that. I looked at that quite a bit today. And so hopefully those will answer your questions. If not, man, shoot me a note. And if you want to get, I guess, closer is not the right word. If you want to have more direct access to me, I've set up a Discord server. You can find a link to that in the comments to this video. And as always, if you want to join the group, there's a place for that in the Buy Me a Coffee app below, in the notes as well. And with that, friends, I'm going to sign off of here. And I'm looking forward to a neat week. be sure to let me know one way or the other whether you think having some earnings videos might be helpful or not. So if it's not helpful, I don't want to really go through the effort to do it. But if you guys would find it helpful, it might be worth a try. So we'll see. I'd like some feedback on that if you don't mind. And with that, I promised I was going to get off, so I'm going to get off. I will see you guys on the next one.